I don't care who you are, nobody enjoys watching the value of their investments go down. Dealing with a market correction and a recession can absolutely be a very nerve wracking period of time. Now, it's super important that you take the necessary precautions well ahead of a market correction or a recession. And we're going to dig into some of those things and what they are. In order to make sure that you're not caught off guard by economic unpredictability. So, successfully planning for a correction or a market recession involves a couple of different stages, and the first of which is planning before it actually happens. So, having a clear understanding of the long-term performance that your portfolio needs to perform in order to achieve success will help us to make sure that we have the right allocation even before there's any sort of volatility. That reduces the risk of us being in a position where we feel like we have to make some pretty significant adjustments when we're in the middle of a correction or a recession. So, I mean, think of it as building a strong foundation. You want to prepare your portfolio and your investment accounts to weather any sort of storm. And within the long-term projections, you'll be able to factor in, bad markets and unpredictability. So, looking at the long-term averages will allow you to have the confidence that you're positioned, appropriately. The second thing to be sure to do is to diversify your investments. If you have access to employer stock or stock options or employer shares, or you've had a really big winner within your portfolio, starting to trim and diversify your portfolio to not be as heavy in a single stock can really help protect and reduce the amount of downside that you experience during a recession or a correction. So diversification can be a great tool to make sure that we're not over concentrated in one particular area and make sure, again, that we're able to weather the storm. The third thing that I'm going to touch on is outside of your portfolio, and that is having an appropriate and emergency reserve fund. And depending on your situation, there's different rules of thumb. So if you're employed and you have a W-2 job that's where your compensation isn't very significantly, having 3 to 6 months worth of expenses saved in really accessible cash accounts can be a really good start. There's certainly some situations which warrant having a higher level of cash. If you have an income stream or you own a small business that where your revenues aren't quite as predictable, it's encouraged to have more than that. So I think having that higher level of liquidity before any sort of correction or recession does allow you to have peace of mind that even if you did lose your job, you do have emergency reserves to continue to live off of until you find the next open position. Moreover, these cash reserves can serve as a really great source to scoop up some assets that are on sale. Maybe there's an opportunity to buy a home that is priced down, or you can buy some stocks that have been oversold. So keep this in mind as you build out your emergency reserve. Big picture, and the last thing I'll cover is being emotionally prepared. Market corrections and recessions do happen. This is not something that is abnormal in history. If you look at the U.S. market cycles have averaged roughly 7 years. There's periods of time where they're quicker and periods of time where they're longer. So go into it knowing that we've had previous corrections, we've had previous recessions, and avoid panic selling in the midst of them. And it can be very tempting to try to want to press that sell button, but for investment assets that are set aside for the long term, meaning investment assets that you're not going to need to touch for 5, 10 plus years, really in the course of a market recession or correction, the best thing to do is to not sell out and go to cash. So who should prepare for a market correction or recession? And the short answer here is everyone. Now, there are a particular group of individuals where this is going to more significantly impact, your potential quality of life. So if you are near retirement, having the right portfolio allocation makes a significant difference. Sadly, I've seen cases where people didn't prepare, they panicked, and they ended up having to work several years longer than they originally had anticipated. Moreover, if you're retired and your portfolio is too risky and you're taking ongoing distributions from your portfolio, it can have a significant adverse effect to the overall assets that you hold. So, regardless, no matter your stage in life, it is important to be prepared and be ready, for those corrections. But again, those two particular categories, I think is especially important. So, there you have it. The key stages of preparing for a correction and market recession. There's things to do beforehand, things to not do during, and big picture, it's again really important to have the overall portfolio allocation that's in alignment with the long-term investment objectives of your financial plan. So again, hopefully you're able to use this information, be prepared, and use these periods of turmoil as potential opportunity. And so with that, thank you for watching. Hope you found this video helpful. And if you have questions, feel free to reach out. Thank you.